So our first hit of panic was that when they say we will legislate, we're still secretly hoping that it doesn't become legislation, which unfortunately it probably will. And as soon as it happens, then we'll sort of say, good Lord, it is a legislation. Then we'll have a second dip of the emotion and then it will sort of settle in. So this period of time is genuinely an opportunity, in my mind, only for the sophisticated investors who can go through the storm, who has got some, I suppose, the mitigation factor in their hand, which is enough level of the liquidity, and which they have the option. For the newer investors, whether you sort of be a little bit more careful, but as long as you've got that longer term view, it will balance out.
Hello everyone and welcome to another episode of Building Generational Wealth through Strategic Property Investment. I'm your co-host Sandeep Jagtap. I've got with me our co-host and friend George Churchian. And today we have got an expert friend of ours who has done everything accounting, everything property investing for more than close to 3 decades. Munzurul Khan, the chair of KHI Partners. Munzurul, how are you?
Very good. Thank you very much. Thank you. Thank you for having me, Sandeep. Thank you.
It's a pleasure to be with you on the podcast, Munzurul. It's really an honor to be with you because every time we listen to you, we learn something every time, even if we have listened to you 50 times over. So,
No, thank you.
A little bit of background about Munzurul and KHI Partners. Most of our audience may know Munzurul as he has helped them in their property investment journey. Munzurul is the chair of KHI Partners. KHI Partners is an organization which has got multiple businesses, Munzurul, the accounting, financial planning, buyer's agents, mortgage booking, legal, and you name, and we've got all the partners in there.
That's right. We've been very blessed over the years, Sandeep. I mean, we started around 18 years ago. And 18 years ago when I started, I literally had 5 clients and with not a whole lot of bigger dreams and goals is in day one when I started 18 years ago. And I look back after 18 years and we sort of feel very, very blessed in many different ways. We've been very blessed. We've got multiple offices in Australia. We've got overseas offices. We've got a large group back in Philippines as well as in Australia. There are 7 service lines that we do. So very blessed. Thank you.
And Munzurul, you are one of the leading accounting practices in Australia as such.
I mean, thank you. Very, very, very humbling. I mean, there are big 4 and of course there are many larger practices which are sort of big and much bigger than us. We sort of stay back to our true goal. And our goal is that if you look into anywhere in our website, it's sort of all says contributing to your life. And we try to live, we try to breathe, and we try to understand and re-understand what does contributing to your life means. And to us, contributing to your life means that it's all about giving and not to worry too much of what the result would be. Is that if you give and give and give to the best of your knowledge, it doesn't mean it's always perfect. It doesn't mean that we never ever make an error. And we do all of the above. But we try to take the accountability of it and we try to rectify that next time. And when we do it this way with that unconditional giving as such, is that the universe has a way of balancing it out.
Munzurul, I can confirm that as being your client and you have helped a lot of our clients and we've got so much working with KHI over the years. So we are truly blessed to be connected with a practice like yours. And since today we are talking and dissecting the budget as such and what it means for the investors, a little bit about your investing journey, Munzurul. I believe you started in 1998. If I'm not wrong.
That's right, 1999 is that when I bought my very first property. There was no master plan. It's sort of my father wanted me to buy the property. I actually had no intention of buying property back in 1999. This is someone who's early young 20s and whoa, to buy property shares are exciting, George.
Yes.
They sort of go up on daily basis. You can see what percentage it increased. This is early 20,
very
sort
exciting.
Of a young lad, sort of a younger lad, sort
Absolutely.
of a speaking, right? It's exciting. You can check it every day and you know just that tiny bit of the knowledge and you become so proud of yourself. And properties are boring, right? I mean, why would you do the properties? You've got the tenants who's got the hot water system and this supply and this. This is a early 20-year-old sort of speaking. So Sandeep, I shared that in different occasion that there No, I suppose, of course, there was no vision, there was no wisdom, there was no knowledge, there was no foresight of someone sort of that early 20s. I relied on my father's foresight. But I suppose what I did well, looking back to it, is that even though I sort of disagreed with him, I still listened to him. And I sort of said,
Key thing for youngsters listening into this.
I disagreed with him vigorously at that stage. And I still remember for about after I bought the first property, George, for about 6 months, I complained to my father that was the worst financial decision I've ever done. This is me as an accountant of telling you, my father, that was not a right decision, right? 6 months. I look back now after that many years and I say, good Lord, that tiny little property that I bought,
Yes.
it was a very humble, very basic, nothing extraordinary, absolutely nothing extraordinary, that property that sort of built in so many different ways the wealth. It's the consistency and persistency of that investment journey which built.
Yeah, so the reason to have you with us on this podcast, Munzurul, is because you've been an investor close to 3 decades and you've seen a lot of things that have changed and some really significant changes over the years. However, investing has still continued.
Yes.
And that's where we are today at a crossroad after 1985. Negative gearing has been touched again. So it's nearly, 40 odd years later we are looking at. And then a lot of investors have got a lot of nervousness, I believe, even when it comes to investing. And that's the reason why we would sort of have a discussion and understand from you how one needs to approach it with a difference going forward and continue building wealth.
Thank you. Thank you. And Sandeep and George, I'm really looking forward to it. And the reason I'm looking forward to it is that this is where the years of experience, as you said, that we share. And there would be some, I suppose, very defined message that I want to pass. And that defined message is that the world is not going to collapse. There would always be a solution to it. And one must not panic. But at the same time is that we need to understand the nitty-gritty behind it so we can structure, organize, slightly reorganize if that is what we need to.
Great. Before we go ahead, a disclaimer, this is not financial advice. This is general discussion. We are trying to understand from an accountant's, buyer's agent's and a mortgage broker's perspective how the budget is going to affect investing going forward and what are the options going forward. So please make sure that you consult your accountants and financial planners before you make any financial decisions. So let's get started. George, if you could summarize for us the current landscape and what's been happening over the last few years, rising interest rates, inflation, the geopolitical conditions, and a lot of things happening at the same time, man.
There is. It's really hard to look back and think and identify a period where things were stable for quite some long time. So, and for me, when I look at that, it's pre-COVID, where we had the historic low interest rates, and they were that way for quite some time. But since COVID, we also had the increased rate cycles where we had record highs at that time. Then we went through a cutting cycle. But then ultimately, since then, we've also had rate increases. Then when we look at global climates, obviously there's a conflict in the Middle East. We're now going through cost of inflation, which seems to be quite persistent. And despite the Reserve Bank throwing everything it can at it, with the increase in cash rates, inflation remains persistent. So there are multiple things. And then when you now couple that with some of the proposed changes in the budget, which is yet to be legislated, it has really made things quite dynamic and quite a complex environment for investors to navigate.
Yeah, and Munzurul, as George mentioned, it's yet to be legislated. But there are, when it comes to property investors or investors in general, 3 things are at play: the negative gearing changes, capital gains tax changes, and the trust
That's right.
Yeah. So these are the 3 key areas we would like to sort of understand from you. So how do you see the overall high level changes as such, and how probably an investor can look at it without being too worried or too scared about the changes?
Yeah. And we probably should go a little bit deeper onto each one of those.
Yeah.
But just to give a high level sort of the overall, is that how would the investor sort of look into it? I suppose, Sandeep, the first comment which I want to say, George raised this point. You said dynamic is the environment that we are at the moment, which is exactly right. And if we speak about the dynamism, so to speak, is that if we look back in the last year, we say that, well, interest rate will drop. and we had a couple of drop, and then we sort of say it should drop even more. Then we said, hang on, sorry, we got the inflation wrong.
Yes.
And because we got the inflation wrong, then we look into some of the other OECD countries, they're doing well, but we've sort of made a little bit of mess with the inflation. Then we sort of said, maybe we just need to pause. And then we said, we need to increase the interest rate. So we started increasing the interest rate. Early this year, we sort of came in saying that the interest rate will really increase. And it has done 3 increases this year.
Yes.
We're probably one of the highest in the OECD country at the moment in terms of the interest rate side of it. But now, with all those changes coming in, now I'm hearing a slowly sort of coming in saying, well, unemployment rate has gone up from 4.3 to 4.5% now. And while the inflation is still sitting as 4.6, you look into the vacancy rate, it's much lower. So when we take away all of those, now we started speaking saying, oof, shall we do a bit of a pause on the interest rate? Should the interest rate go into more reverse? Shall we go back to that sort of, I suppose, reduction of the interest rate again? So the comment comes back, Sandeep, is that the market where we are at the moment is that there are many things we are yet to be settled.
Yes.
And when there are many things which are yet to be settled, that whole dust yet to be settled, the way I see it for all the investors side of it is that even if we just take a moment and sort of say, let some of the things to be settled, so we make an informed decision, i.e. we don't rush into the market, we don't rush into and go around and change a whole lot of things simply because it came in into the budget. The first comment is, as you say, that it hasn't been legislated. All likelihood when it comes to the budget that it sort of fundamentally becomes legislation, yeah? But all likelihood is that even if it becomes legislation is that smaller things can be changed and adjusted and tweaked. And very often those smaller things which are adjusted and tweaked has a big impact in different industry. So we stay aware of it, but do we really immediately need to make some of the decision to make big changes? Perhaps not.
So, yes, as Munzurul said, we can expect a bit of tweak to a few things which may make a huge difference going forward, a little bit of positivity going forward.
Yeah.
So, George, given the current things which are not yet settled, what do you see in the market as a moment as a buyer's agent? What do you see post the budget speech until now? How do you see the market sort of behaving?
Great question. I find the buyer psychology very, very fascinating because we almost wait as a population for that interest rate announcement and then most recently the budget. So I've noticed a 2-step market at the moment. So some of the less experienced investors are very much looking at that as a signal to pause, to assess. They've gone back rightfully, looking at their borrowing capacity, which I know has been impacted, and they're looking at their strategy as well, and a lot of analysis. What I do also notice is there's no shortage of information. So you could spend a lot of time reviewing information, analyzing, obtaining advice, which is very important. But then at a point in time, you kind of do need to lean into your strategy. On the flip side, the observation is some of the more seasoned investors that I'm seeing are coming and saying, George, if anything does cross your desk in terms of an opportunity where the numbers work well, there's a chance for us to enter that particular market at a discount, then we want to know about it. And typically we find from a vendor perspective, those who don't need to transact right now are not transacting, but that's not the case for everybody. There are life circumstances that will dictate when someone needs to sell a property or an asset. And within those opportunities is where essentially lies the chance for you to get something at a discount.
Yeah, and that's really key, Munzurul. Like whenever such news comes in, there's a little bit of time where there is panic all over the place, right? And as things start sort of evolving, people get comfortable with it and people readjust themselves to what's been happening, and then the investing continues.
That's right. I mean, you always have that immediate sort of the reaction as such, yeah? There is this Chinese proverb saying that when you are in that moment, and speaking in English, I suppose, is that when you are in that moment where there is an immediate changes, even if your instinct sort of says, that's what we need to do, you never ever make that decision right at that point of time. You give yourself a bit of a time and you sort of come back and you re-reflect, you let that go through with your mind, let have a little bit more information being gathered, make that measured decision. Because we come back to the 2 points. Yeah, point one that you raised is that you go back to the individual strategies, fundamental. Let the world do what it does, is that yes, you get all of those information from the world. You have to stay true to your individual strategy, which is goals and objectives in the longer period of time. The second comment which I wanted to say is that property investment naturally is a very long-term investment. Very long-term investment, yeah? I'd probably dare suggest that someone who's sort of say early 30s as an example, and so 30 years of an investment, that these changes that we've seen, there would be many, 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 many more changes that they have to go through, good and bad, and sort of making sense as well as not making sense, right? So all of those challenges we will go through, keeping in mind it is a longer period, and keeping in mind you stay true to your goals and objectives is what we do.
Great. And to add to what George said, there's a little bit of confusion in the market. There's a bit of confusion when it comes to lending as such as well, because it's not legislated. However, the banks are sort of reworking in the background how things will change. And one key thing which would probably change is the borrowing capacity when an investor wants to buy an established investment property, because more often banks would take the cost of holding the property as the negative gearing calculations, and that would probably help the borrowing capacity. In the absence of it, probably, if I'm not wrong, depending on the client situation, depending on their tax brackets, depending on their existing portfolio, one would probably safely say that 15% drop in the borrowing capacity if this was to go through, and if the changes the banks have to bring in. However, it's not the entire sort of negative gearing gone. They will still negatively get the rent that is earned from that property plus any other properties, right? Is that correct, Munzurul?
That's right. I mean, a couple of points in here, Sandeep. The first point is that you're right. I mean, looking through, without naming any of the banks, is that the banks have started to move.
Yes.
In terms of the negative gearing, number of banks, they've started to move, even though it hasn't been legislated as yet, right? So, and these are the prominent banks that they sort of started to move in terms of doing these things, But at the same time, what it does, Sandeep, is that if we look forward, we sort of say that, well, at the end of the day, the banks are there for lending. Yes, okay, there would be a presumed level of reduction in terms of negative gearing benefit and in terms of your serviceability. Let it be around that 15%. But how many people are going to buy brand new property? There would still be people who's buying existing property. So looking back in the history, bank will come up with a new way of doing serviceability, new product. They will find a solution, because at the end of the day, that's the market, that's the lending that we wish to do.
Yeah, so Munzurul, with the negative gearing, there's a lot of noise, and we see a lot of things at the moment. It's negative gearing is gone when it comes to established property, but technically it's not gone. It's just postponed in the investment journey as such. Is that correct? Am I understanding it correctly when it comes to buying an established property?
Absolutely. Cannot be any more correct. And the reason I say cannot be any more correct is because, George, when we look back into that news after 12th of May, I mean, the next day, the big news sort of came in, negative gearing is being abolished. It hasn't been abolished. It's the process has changed.
Yes.
Do we like the process? Whether we do, whether we don't, I personally don't, but, it's sort of changed. And all that basically means is that there are a couple of rules. So they've got a grandfather provision. And the grandfather provision means that anyone who has either a contract or has an actual property before the budget date, which is that 12th of May, 5 p.m. or so, is that if you signed a contract or you actually own a property at that stage of settlement has no bearing, So you signed a contract which is unconditionally, i.e. that you own a particular property at that point of time, let it be old, let it be new, is that the grandfather provisioning allows you to continue the negative gearing in the old way, which is the current way. What is the current way and old way? Is that negative gearing, if you've got a $20,000 rental income, you've got $25,000 expense, that $5,000 which is on negative gearing, i.e. our expenses are higher than the income, that $5,000 I can utilize against my salaries and wages. And I get some marginal tax benefit because of that $5,000. That's the process. That will continue, that grandfathering provision of the existing property. Second thing, which will also continue, the brand new properties here, and the brand new properties who buy since then will continue. Where the changes comes in are the existing properties who buys after 12th of May 2026. And those existing properties, what they buy is from 1st of July 2027 onward, is that if you have, on that example, 20,000 rental income, 25,000 is your rental expenses, you cannot offset that against your salaries and wages, but you do not lose those losses. You carry forward that loss. So you've got a $5,000 this year. Next year you might get another $7,000. Year after you might get another $3,000. So over 3 years you've got about $15,000. And in 3 years' time, let's say your property has started becoming positive cash flow. Now say in year 4, you've got a $4,000 positive cash flow. So you will use that $4,000 positive cash flow to reduce that 15,000 negative gearing. So it's a loss which gets carried forward to be utilized in future against the rental income or capital gains.
Great. So that is really, really important point, because negative gearing is not gone. It is changed a little bit.
Yep.
And along with it has changed the capital gains tax, how the way it is going to be worked at. So I know you said that if I've got losses accumulated over a period of time, they can offset against the CGT calculations as such. How can you tell us what how CGT has changed?
Thank you.
And how it's going to look for going forward?
Good question. The losses which we carry forward on that example that we sort of said over 3 years, you sort of accumulate about $15,000 loss, year 4, you gain a $4,000 gain. So your loss is now $11,000 a year. Or let's say if we change that example and we say we continue that losses for a few more years, you don't lose the losses. Yeah. What we read on the legislation on the budget side of it, that the losses gets carried forward forever, unless and until you get some level of revenue against the rental property as a positive cash flow and or the CGT. So CGT is the second massive change. Yeah. So negative gearing is number one. CGT is also a second. So CGT, what we used to have, Sandeep, we used to have the 50% discount to anyone who owns the property for 12 months or longer. And anyone means as an individual.
Yes.
Different rule with the corporate entity, different rule with the self-managed super fund. Self-managed super fund, you get a 1/3 discount as opposed to 50%. Corporate entity, you never received a discount. Trust, you receive a discount on the basis of who you distribute. If the trust distributes to an individual, then you get a 50% discount. Yeah. So that was the old rule. The old rule is that you bought a property for, $800,000 and you sold it for 1.8 mil. You made a $1 million profit. You get a 50% discount, 500,000. The other 500,000 you pay tax at your marginal rule. So that's the old rule. Now, what the new rule sort of says, that, the CGT discount as 50% discount will stay up until 30th of June 2027. And from 1st of July 2027, we will go back into a process called indexation method. And what the indexation method means is that from 1st of July 2027 is that it would be taxed on the real gain that you made on that asset. So if we go through the example, is that you bought a property for $800,000 and you sort of had some gain. What the rule says is that as of 30th of June 2027, you need to do a valuation of that property. Let's assume that we've done a valuation on 30th of June 2027, and the valuation comes into 1.8 for argument's sake. Yeah. So you bought it for 800,000 a number of years ago. Now it comes into 1.8 as at 1st of July 2027. Let's just say in few years later, you sold it. You sold it in 2032. So rather than 1.8, you actually sold it to 2.8 on that example, yeah? So where the CGT now applies is that from 800,000 that you bought to the market value, which is 1st of July 2027, that $1 million gain that you received is that you get a 50% discount. So you still have that discount up until June 2027. But all it is from June 2027 onward is that you got to do an indexation method. And the indexation method means that $1 million value, which now becomes my cost base, how much has that value increased over a period of time in terms of the CPI? And whatever the value increased as opposed to what you are selling, it would be taxed at your marginal rate.
And that is where all the negative gearing losses and all that have been carried over.
That's right.
Over the number of years.
That's right. And they would be carried over in the sense that on that example is that say 800,000, you sort of had 1.8 is the market value and you happen to have sold for 2.8 million as such, right? So you made quite a bit of profit. You made about $2.8 million profit as such, right? So you'd be utilizing all of if you have any other capital losses, you would always be utilizing the capital losses first. That's the order of claiming the losses. You may have some other property, you may have some other crypto or shares or something else you sold, and you've got $100,000 loss. So we'll always utilize that loss first. And then once we utilize that loss, all those negative gearing losses that you had, you would be utilizing them before you pay the tax. So the point in here is that your benefit has not been taken away. It's effectively is a timing difference. Rather than receiving it every year, you would receive those benefit at some point of event. And some point of event means that your property is either become positive cash flow or you sold and you had a gain. So you haven't lost it, it's just been deferred.
It's quite a complex way. It makes the life of accountants a bit difficult with the, like, if I'm a client of KHI Partners and I've got half a dozen properties till now, and I add another 2 or 3 properties, it's going to be a massive task to sort of...
That's why you have the experts. That's why you have the experts.
It has become complex here, and I agree. And where also the complexity is that there are some, devils very often is on the detail, and some of the details that we're still trying to sort of understand. What is the definition of a brand new property as an example? So you've got a property, you demolish, you build another property. Is that a brand new property? Well, our reading is that it doesn't appear to be a brand new property. But if you've got a property which you demolish and you build a duplex, is that a brand new property? And our reading is that is a brand new property. So you would see those sort of little sort of the differences is that would be coming through along the way.
I remember reading somewhere, Munzurul, where if you're contributing to the supply of housing, so in that scenario, you knock down an existing and you build a duplex.
Yes.
So you're effectively increasing supply.
Yes.
Then you get the benefit of the negative gearing.
Yes.
Is that a fair assumption?
It is absolutely fair assumption, right? Because that's a brand new property and that's where it's sort of coming in. But all of those, as far as the little technicality, George, is that they all need to be, number one, is being legislated.
Yes, that's right.
And number two, I suppose in an ideal world, we need to see some of the court cases to go through. So we understand some of those here.
Yes.
But generally speaking at this stage, yes, it is the supply. Yes, it is rather than sort of replacing an old to a new, is that you're building a new is a definition of a new.
And have they made any changes, or are there any proposed changes to the 6-year CGT rule?
No, good question. Good question, George. There are a number of things which hasn't changed here. It hasn't changed. And 6 years provision at this stage is that it hasn't changed. Your principal place of residency exemption hasn't changed, and your self-managed super fund, as an example, hasn't changed. Even the commercial property, some of the negative gearing hasn't changed. But 6-year provision definitely hasn't changed.
Yeah, interesting. Would you expect to see more people move into the self-managed super fund space where they've previously explored it but not pulled the trigger?
Yeah, look, I think self-managed super fund is that arguably there would be a demand whether it gets raised, because the benefit hasn't been changed. We still take a couple of things into perspective here. Number one, what we take into perspective is that while there is a discount on the self-managed super fund, the discount is a 1/3 discount.
Yes.
And when we speak that there is a 1/3 discount, self-managed super funds or any super funds tax rate is 15%.
Yes.
So it really is dropping from 15 to 10% is that 1/3 discount. As opposed to outside, you get a 47% and you get a 50% discount, which drops down to 23.5. So the relative benefit on the self-managed super fund, i.e. the benefit that you're not receiving outside, one still argues that it's marginal. But I think the main with the self-managed super fund, the restriction, George, is that the cash injection or the fund injection is that even if you have lots of wealth, even if you have lots of supply of the cash, so to speak, you're limited to how much cash that you can put in on the self-managed super fund. You can do up to 30,000 as a maximum concessional contribution, which is tax benefit. You can do some personal contribution as well, but you're limited to how much. So I think the emotion towards the self-managed super fund will definitely improve.
Yes.
Whether it gets still limited somehow with the financing side of it, that how much that I can do, even if I wish to do it, Sandeep.
Yeah, look, Munzurul, yes, $30,000 a year concessional cap, and you can go back a few years in the history, maybe 5 years, if I'm not wrong.
There are some, good point, mate. There are some restriction in the sense that you can go back as concessional carryback provision, as they call it, right? So you definitely can. The challenges is that, or the restriction is that if your fund is over 500,000, as an example, your members fund, then you're not eligible to it. So you can with some restriction.
Yeah. So when it comes to the borrowing capacity under the self-managed super fund, the lenders which work in this space have really good ways of looking at how serviceability works, because interest rates in self-managed super funds are not cheap. They are expensive, and that's where the servicing becomes a bit difficult. However, a lot of lenders have got something called servicing outside the super or below the line servicing, which we take into consideration the entire situation of the client, including their personal incomes, their rental incomes, their personal portfolios, personal liabilities, and if they have got that surplus left over to contribute into that super, that can be used towards the borrowing capacity, and that's how one can boost the borrowing capacity and sort of help purchase into the self-managed super fund.
Lovely. So self-managed super fund, there would be a bit more interest, absolutely. Where I suppose, George, that there is that sense of consciousness is that this year the budget really hasn't touched the super.
No.
But traditionally, budget is quite keen on the super, because super is sort of almost that honey pot that you sort of play with it. We just get a little bit of benefit. Every year the government sort of seems to tickle away with the super fund. That additional tax after 250 odd grand taxable income that came in a few years ago, right? Prior to that, we didn't have that extra 15% tax as such. So they always sort of play around. This year, they haven't. There are far too many other bigger things that do sort of play around. And where one got to be still slightly, I suppose, pragmatic is that nothing changed on the super fund this year. Unfortunately, it doesn't mean that it will not change over the years.
In future years. And it's quite a fine balancing act for the government, I imagine, because ultimately it's designed to fund retirement, right? So if there's a short-term pressure in the market and they need to raise revenue, and you look at it and you go, well, that's that honeypot that I'm going to dip into now. Well, you're kind of kicking a problem down the road, aren't you? Because ultimately when the current generation comes to retire, if you've dissolved or eaten into their nest egg, then it becomes another problem for the government to fix, albeit 10, 15 years later.
Yeah, and that's why I think very often the way I try to see it on a pragmatic way is that, do I have more interest on self-managed super fund as an investment? I sort of say that rather than going that question, I look into the investor by themselves. And none of this are financial planning advice, wealth advice, not at all. Is that in my mind, I sort of say, who am I speaking to? Am I speaking to a 30-year-old couple, or am I speaking to a 55-year-old couple as such, or am I speaking to a 45-year-old couple? And I would probably argue the answer that how much deeper you want to go in the self-managed super fund arguably would be slightly different to all those different couples as such, right? The strategy of someone who's sort of 55 would be very different to someone who's sort of the early 30s. That's point number one. And the point number two is that you also need to look through all the surrounding matters, right? So those early 30 couple, do they have their principal place of residence? Has that been fully paid? Have you taken away that sort of the non-deductible, the interest as such, as opposed to someone who's sort of, say, mid-50s, as an example, if they've already paid off their home loan, they've got nothing which is non-deductibility, and they're sort of a little bit closer to the retirement, is that becomes just a bit more sort of prominent. And even if we look on a statutory risk, the risk is lower because they're just that much closer to the retirement.
It's fascinating. There's a lot there to juggle, isn't there?
Oh, we'll only learn as time goes.
Absolutely.
So, George, PPR upcycling, what are your thoughts? And would like to know from Munzurul on that.
Yeah, so I guess, again, things are obviously not legislated, but a lot of the discussion I'm having with especially the more strategy-focused clients are, what do we do if this becomes legislated? So some of the discussions are around, the PPOR essentially created was the stepping stone for wealth creation for a lot of people at the moment. So do we then start to explore upcycling of our principal place of residence? So that's a conversation that's been gaining momentum. Do we then look at, if I'm going to get a benefit from increasing supply to the housing market, and I don't necessarily subscribe to buying a house and land product in the regions, then do I look at small-scale development opportunities where if I own an unencumbered block of land and do a duplex development, do I explore that as a strategy? I guess, Munzurul, with the presence of KHI and the client base, are there any early discussions and strategies that are being soundboarded with the team?
Yeah, look, the principal place of residence is that, good question, George. Principal place of residence is that when you do that upscale, so to speak, is that under the current rule, there is no tax ramification as such. I mean, that whole exemption of the principal place of residence, it sort of remains. So yes, we've got a number of clients who sort of does that either as a strategy and or as the natural flow in life. Yeah. So you buy your small property, your sort of the household income sort of increases, your family expands, and you naturally have to go into a bigger home.
Yes.
And before you know, you go into much bigger home. And before you know, the kids sort of grown, and then you sort of say, what do we do with this very large home? And you sort of start downscaling as such. So there is a natural pathway, but have we seen clients who sort of does that as a strategy? And the answer is we have. Where one got to be slightly watchful, George, is that Etio sort of says that, well, if you're doing that as part of your natural process, i.e. there is a commercial reason behind it, there is an objective why you're doing it, that's all good. But if you're doing it purely because of the tax benefits, so to speak, that I'm going to buy a home, stay in there for a couple of years, do a whole bunch of renovation as such, sell that home because it's a CGT free, then I move into the next property, I do it again, then I move into the next property, I do it again, then it sort of becomes under the tax avoidance because you're doing it purely because of the tax benefit
Financial gain.
without having any commercial reason behind it. But if you can justify is that, well, I bought this property, my intention has changed,
Yes.
then it's okay. So have I seen this strategy? Yes. Intention is important, and just keeping the tax and I suppose tax strategy and avoidance into mind as well.
Absolutely. And do you find, for instance, I guess if these changes do come into effect, that those investors who are more sophisticated will actually shift to more cash flow positive properties, i.e. commercial properties?
Yeah, and that's really, I suppose, prudent, right, is the question that you're saying. Because, say, George, and we alluded that right at the beginning of this podcast, is that commercial property is one that hasn't changed in terms of those tax benefits side of it, right? And if the commercial property hasn't changed, means that naturally there would be a bit more inclination in terms of people going into the commercial property. So I would dare suggest that the interest in the commercial property will increase, definitely will. I suppose if you look back into some of the rental return and you sort of say that we wish that the rental return were a little bit higher.
Yes.
And that's probably the only sort of the challenge, but there is no question at all that the interest in the commercial property, just a little bit more cash flow incentive as such, will increase. The other comment which I say is that if we go back to the residential property, one probably strongly argues that if we look back into 1985 and what happened last time when we tried to do this whole negative gearing again, rent has naturally increased quite significantly within that period of time with the residential property. So while there would definitely be more interest on the commercial property, and I agree with this, but on equal note, I sort of say that the rent on the existing residential property probably will increase quite a bit as well.
And that's an important point you touch on, because I guess the ultimate sort of driver of some of the changes that are proposed and yet to be legislated is very much to help that home buyer, right? So it's to help them get into the market. But then when you sort of overlay some of the other decisions, for instance, things like allowing investors to negative gear new build properties from July 2027 onwards, but then at the same time putting foreign investors in the same pool as these home buyers. So you've got a struggling local population who is being pitted against a cashed up foreign investor for the same asset pool. So are they really going to be able to compete is a question one would ask.
Yeah, and you're right. I think, George, a fundamental sort of the debate sort of comes in with the budget side of it exactly on that matter, is that the whole thinking seems to be more in terms of the demand side of it.
Yes.
Is to more sort of play with the demand, articulate the demand, restructure the demand, direct the demand in a certain way, which is harder. Because if you look into the world of the economics, right, you've got the supply and the demand, and the demand is harder in the sense that it's almost a butterfly effect. So you've got many different variables that you've got to manage, and they're not all science. They also include the art, and some of those are emotion as such, right? And you got to almost manage all those different science and the art of the variables to manage the demand. And I always sort of wonder on the other side, which is the supply side of it, is that do we put in enough level of time, effort, and a strategy on the supply side of it? Yeah. I was speaking to a client this morning, and I was sort of saying that, well, would it not be interesting if government were to come up randomly, let's say as an example, government were to come up with this strategy such as saying that, okay, there is this huge supply of the new lands that we're giving. Australia is a large country, right?
Yes.
So there's all this new level of supply of the land that we're giving, and I'll make it up, right? Let's say that anyone who's a first-time buyer, as an example, that if you buy a land, there would be a 20% reduction and 20% discount being provided to you only to a first-time buyer who buys the land for the first time. So if I look into a young lad, our son is 22 years old, right? I mean, he worked really hard. He saved a small amount of cash, but saving every single cent and penny. In his world, that's a big saving, right?
Of course.
But in the world of when you have 1.7 million is the median price, that saving, how much does it go, right?
Yes.
So it's sort of almost that loss game. How do you go over it? So I wonder that whether that supply side were to be looked into and a discount is being provided by the government, either from the land or from the construction, ideally both, whether that would define the problem a bit more solution-centric.
Yeah, I think it's a really good point because a lot of the measures are very much around dampening demand as opposed to pure supply side solutions. I think to your point as well, it's quite fascinating. A concept I heard casually and socially a few months ago was we obviously have first home buyer incentives, but it would be interesting to have an incentive for a last home buyer as well. So we often talk about we do talk about sort of the aging population and the empty nesters, I think is the term, where the kids are grown, they've got the 5-bedroom house, which they don't need. They're unencumbered. But the challenge they have is if they downsize, they're going to pay $50,000, $60,000, $70,000 in stamp duty.
Yes.
So you might turn around and say, Mr. and Mrs. Homeowner, we want to incentivize you. And this is sort of true supply side is there'd be a significant stamp duty discount or no stamp duty if you're retired. So you'd somehow measure it and you'd stress test it. But then it becomes, really something worthwhile considering because if you can go down without paying the tax, then why wouldn't you?
Yes, very good point. Really good point, George. And this is now I've learned from you. And thank you that, we speak about the first-time buyers all the time, but how do we look onto the end side of it of people when they're retiring? A similar example, if I may use as to complement your point, is the land tax side of it, yeah? Yes. I mean, how often do we see that mom and dad, sort of the investor, they receive this inheritance of the property from their parents' side of it, which they may have bought for years and years ago, and there is significant asset value with that property, emotional tie attached to it, and they keep that as a rental property. They get hardly about 3%, maybe less than 3% as a rental return until the dreaded land tax comes in.
Yes.
And the land tax takes away literally all of the rental return. And they sort of say, it makes no sense, right, in terms of how do we do it? So there are those deficiencies, absolutely.
Okay. So, Munzurul, with these grandfathering provisions for properties already held by investors, there's this question popping up really frequently in the short span of time is one extra property, can that be added using the grandfathering provisions? Because, say, for example, I've got a principal place of residence which I've been living for the last 5 years.
Yes.
Which was bought before the budget.
Yes.
And I thought, okay, can I upgrade my principal place of residence, buy a new property, and this, because it was purchased before the budget night, would still fall under those existing rules? Would something like that sort of be thought by?
Yeah, some of the good question, complex question, some of those details that we sort of said, devil in the details that we're still clarifying. But what the reading says that we go on a title by title basis, right? So it's all about that you had that particular title of that property, and grandfather provisioning applies on individual title. It's not replacing of something else from one title to a new title. You may replace from the existing dwelling to a new dwelling. That's a different thing, right? But you can't sort of swap a title from this title to a new title. The original title remains as such.
Yeah, so a lot of things will be sort of clear as the legislation comes into play, and a lot of discussions happen before it sort of is reflected into the policies as such, right? Mm-hmm. And another thing, Munzurul, they have done, they have sort of kept the negative gearing as it is for the brand new properties. However, is that really a solution to a problem? Because if, say, for example, my son who is 24 years old wants to go and buy a brand new property or a home and land package as an investment property, it's a great investment. He buys it. Investment negative gearing for us is not a strategy. It's just a part of the benefits we get there. But when he wants to exit, that suddenly is not a brand new property for somebody who wants to buy it. So would that be a situation where getting in there just for the sake of negative gearing, and how's the exit going to be difficult when it comes to it? Was
brilliant point. So they were absolutely brilliant point in many different way. And the reason I say absolutely brilliant question in many different way is that first question is that the brand new property that on that example, let's say if your son were to consider to buy that brand new property as such, right? We're getting diverted to the true, I suppose, the objective. The true objective is on this example is the wealth creation, wealth preservation, wealth expansion as such, right? And we're sort of getting diverted in terms of the tax side of it. The question that I ask is that before we go into any of the negative gearing, does that brand new property make sense in the longer period of time in terms of that consistent level of the growth that we are hoping a property does, whether 7-10% that we sort of say over a period of time, whether it does, right? So I think we get diverted with this as soon as we go into that negative gearing side of it. So that's a risk is what you're identifying, which I agree with you. I'm agreeing with you that, the investment should not be done purely because on the tax benefits side of it, tax should only be taken as a, as I suppose, a bonus as such, yeah? But what are you also identifying is that not so much on the entry, but on the exit. So your son is sort of buying this, right? And it's a brand new property. He's received a little bit of benefit from his point of view. That's fine. When I'm buying this from your son as an investor in say 10 years time, 15 years time as such, I don't have that incentive anymore. Does that mean that he loses a little bit of a shine on the valuation of that property? Is the question that you ask.
Yeah.
And I tend to agree with this. That's why I still go back saying that we need to be aware of the tax benefit, but we need to get our priority right. Our priority is still exactly the same as it was before the budget, is that what property makes sense for a longer period of time. We buy that property. Then if it's a brand new, it's a bonus. If it's not a brand new, we leave with this because our primary objective, which is the growth, we've achieved this.
Yeah, interesting one. It's just not that new properties are going to be exceptional properties and everybody should be chasing the home and land packages and new builds.
No, and if you look through Sandeep, is that I was speaking to someone else the other day, and I was sort of saying that we very often, one is that we look into the history to learn, and number two is that we look into some of the other countries who sort of built and developed and grew, and who may have tried this in some of the other countries. We try to learn from them. It's been tried. That whole mechanism of the brand new property and creating that incentive through the tax has been tried in Europe quite considerably. And what Europe tells us is that when we look back to it, is that the whole mechanism doesn't work. Anywhere it's been tried after 2 or 3 years, 4 years, is that it was being abolished. Exactly same as we had the negative gearing was done in 1985, it was abolished in 87. Is that
because the rent shot up.
That's right. And a whole lot of demographical differences and so forth and anomalies that it created in terms of our living standard. Right, but that whole brand new property of creating the incentive, trying to get people to buy this, it was being tried in overseas. It did not work. So in Australia, it comes back is that we're trying something which some of the other nations have already tried. It didn't work, and we've sort of ignored it, and we're hoping that somehow it becomes a difference to us.
So, Munzurul, obviously with the government's proposed changes, they're quite ambitious. I think it's probably a good way of putting it. And we saw similar ambitious legislation try to pass at state level a few years ago, with Queensland trying to look at land tax based off your national holding.
Yes.
And in the 11th hour, they recoiled and they didn't go ahead with that.
Yes.
Do you think at a federal level?
Oh, sorry, my apology. My phone seemed to be speaking. I tried to answer your question. I like my phone.
It might be too complex for them. But with at federal level, though, do you think there's any likelihood that they could repeal and not move forward with what they're proposing?
Really good question again, because it hasn't been asked quite a bit, is that if we look back to that Queensland example that you were saying, George, I still remember that when Queensland just about to come in, the natural reaction very often when something new comes in, which is not in our favor, is that very often we tend to panic. Yeah. And I remember at some point, really even sophisticated client groups, they actually call saying that I'm selling all my properties in Queensland. It makes no sense. We're doing all of those. We're selling it. And my advice at that stage, or my thinking at that stage, is that let's just wait for the dust to settle that a bit, so we really understand what the ramification is. We can read the rule, we can understand it, but let's feel the economy, how the economy does. So I was being asked very strongly that, Munzurul, what are you planning to do? Because you've got a whole bunch of investments in Queensland. And I said, I'm not going to sell anything. Why I would not sell anything at that stage when it hasn't been repealed as yet.
Yes.
We were right in the middle of it, that Queensland was going to come in, land tax was going to be much higher. And I said, I'm not going to sell it, because what I always rely on few things. And one of the fundamental things that I always rely on this concept called the invisible hand.
Okay.
And in the world of the economics, the invisible hand means that it's a hand which we don't see it's an invisible, and that invisible hand always balances out the anomalies. Okay. Anomalies can be a shorter period of time, but it cannot be the perpetuity. It cannot be a permanent anomalies. It's sort of that whole Murphy's law of average, that everything sort of gets balanced out over a period of time. Invisible hand. So in my mind, at that stage, I'll sort of say that let the government do what they do. I can't control what the government does. What I can control is what I do in terms of my investment. And what I would like to do is to go steady over a longer period of time as opposed to panic decision. So I didn't do any of those sales. I actually had clients who sold significant amount of properties, and then the government came back saying, sorry guys, we're not changing this, because we had a whole bunch of sort of a pushback coming in. By then, some of the clients already sold the properties, and we look back and we say, wow, again, that's a lesson that we learn from our experience. So if we draw down on that experience and you sort of say, well, do we really see the government to repeal some of the sort of proposed changes over a period of time? You know what, George? There is a risk. There is all likelihood to it. Yeah, there's two levels of all likelihood. Number one, the Labor government by itself may sort of say that we're not going to be doing exactly what we said in the budget. I'll give you just one example. Yeah, an unavoidable, I suppose, consequence came in terms of this entire matter is the estate planning. There are some strong detrimental impact came in on the estate planning in terms of the testamentary trust and the distribution because of changes on the trust. Government didn't intend this, but this is one of those things that it sort of came in, and the government is now looking back saying that how do we sort of just tidy that away?
Yes.
Yeah. A similar example, I suppose, is that the new investors, in terms of the new entrepreneurs, when they sort of have this startup and some of the incentive being provided, the government saying that how do we sort of curve it out and still try to incentivize those new entrepreneurs as such. So there's a few things that they're trying to sort of carve out right now. But the bigger question, I suppose, George, I ask is that what happens when the government changes? Because the government changes, right? I mean,
of course,
within the same sort of the authority, you still have different minds comes in. And Labor becomes liberal, and liberal becomes Labor at a point of time, or the First Nation comes in, right? So the government sort of changes. What happens when there is a government change? Would many of those be repelled at that stage? Because it was definitely not the opposition's choice in the past as well as now in terms of any of those abolition.
That's right. They've almost handed them their campaign on a silver tray, haven't they?
That's right. That's right. And I suppose, George, the comment which we say is that, you know, we did that back in 1985, yeah, and we sort of repelled that in 1987. So the question I ask is that why has no one else tried that from 1985 till now, which is 2026? There's a reason to it, right?
Yes.
And the reason was that it was not pleasant when we changed it. The ratification didn't sort of come into where he was, and in a very long way, there were some benefits being provided, but in a very long way, the benefits eventually went back to the people that we were not intending to.
Yes.
It went back to the people that we were not intending. A simple example is that whenever you sort of create an incentive, right, for the first-time buyers, is that where we always sort of see, yes, there is an incentive being provided on the first-time buyers, but invariably markets sort of adjust. And what the market does on those sort of products, the prices increase by that amount.
Yes.
And by pricing increasing, in one hand, first-time buyer sort of says, yes, we've got that bit of the additional level of the benefit, but I'm now paying that extra bit of the cost. So is it really helping the first-time buyers from that example? But who is getting helped? The prices increases means that the existing wealthy people who's got a whole bunch of properties, they're the one who is sort of getting benefited
benefit.
eventually. It is still comes back to that point, George,
Yes.
that it is the supply side of it, which in my opinion has got so much more impact as opposed to trying to play around with the demand.
With the demand.
So would it be fair to say they are not fixing the underlying problem of supply, and we're just trying to sort of fix the supply by making it difficult for the investors or something?
That's right. That's right. I mean, it's probably easier. It's sort of almost a band-aid approach. Try to hit that demand side of it because it's sort of easier to try to fix it. But something which is easy, it doesn't necessarily mean it has got a persistent and long-term resolution behind it. Very often things which are harder to implement are the ones which has got the bigger impact, but they are harder to implement. Yeah. And I suppose a bit of a politics comes in as well, right? Where the politics sort of comes in is that very often the parliament is that it is a period of time, whether it's 3 years, whether it's a 5 years sort of a span that we look through, but we as an investor, we look into a lot longer as such. So yes, it's the supply side of it that I'm a big fan.
And my next question to both of you gentlemen is, all our businesses, we have a lot of mutual clients of ours, and we have helped families build generational wealth in the past.
Yeah.
So there are a lot of mutual clients of us who would be sitting on their principal place of residence plus 3 or 4 properties plus a property in self-managed super fund, and may have capacity to go out and invest again. How would you approach advising the clients from your own perspective or your business's perspective on how, assuming that everything gets legislated and it becomes a norm, how would probably be the approach be from the both the businesses?
George?
So I guess from a property acquisition standpoint, the advisory piece, I guess, would need to be obtained and sought externally by qualified advisors such as KHI and Munzurul and the team. But ultimately, from my perspective, again, we want to anchor something into a strategy. So we've discussed that a lot of the proposed changes are very much going to have accounting treatment impact, and we don't necessarily want to have the accounting treatment impact the investment strategy. So if our borrowing capacity has been carved out or reduced slightly, then we look at it and we say, how can we deploy the capital that we can access? So from a property strategy perspective, if the capital we can access does not allow us to enter markets that we want to enter into, then we look at it and we say, well, how do we consolidate the portfolio that we have? How do we extract maximum value from the portfolio that we have through strategic renovations, a granny flat, second income, what have you? But then also, if they are sophisticated enough and there are opportunities and they hold assets in the right areas, we look at small scale duplexes and things of that nature.
Yeah. I suppose, Sandeep, the first comment which we say, we as an accountant, we can't give a financial planning advice. So we can't sit down with a client saying that you must buy this, you must not buy this, you must sell this, you must do all of those things as such. That's where you've got the statement of advice, the financial planner who does it. But what we have seen with the sophisticated investors in the past, and what I sort of feel that we will see the sophisticated investors will do it again this time, is that they would look back and they would sort of say, wow, rather than this being a anomaly and sort of fear and tear and wear and sort of a stay out of it, is that they would actually genuinely see that as an incredible layer of the opportunity. Yeah, because the fundamental asset hasn't changed. The quality of that fundamental asset hasn't changed. The overall, the longer term emotion also hasn't been changed. All it has changed is that tax changes, and that tax change can also change back at a point of time. So the investors, the sophisticated investors, is that they would be, in my opinion, they would be coming in deeper into the market, saying that this is a great opportunity where we can get some of the properties which are really good values. You know, I'm being sort of seeing some of the Melbourne properties which are really good values that I've seen. And now I'm seeing those properties even more sort of a nominal price than at a value that I thought was a really good value. But they're even more discounted now because of the circumstances as such. And these are the sophisticated investors who will sort of come in and say, you know what, I'm going to buy those properties. I'm going to buy it with the fact that I'm going to rely on the rental. I'm going to buy with the fact that the entire infrastructure, the demography, that sort of the cafe culture and all the sort of the construction. So all the sort of things which are being ticked, I'm going to buy it and I'm going to assume that I'm going to hold it for 10 years, 15 years, 20 years, that period of time. And if I hold it for 10 years, 15 years, and 20 years, what we have as a law, it probably will change another 2-3 times by then. And if I look back over 10 or 15 years, is that the positive and the negative will offset each other. Yeah. And in the longer period of I would be fine. But if I'm buying the property as at today's market value, which is at a discounted price, means that I'm going to get a compounding level of opportunity gain. So I sort of see that many of those investors, they're really sophisticated investors rather than them being completely away on the market. There is a likelihood they may actually go a little bit deeper in the market. They would be doing it in a more measured way. No question. They would be doing it in a little bit more pragmatic way, a little bit more careful way. No question to it. Yes, it would be a little bit harder from a bank and the funding side of it. No question to it. They will try to find a solution to it. So in my case, I sort of say that rather than being quite a bit of an uncertainty, this probably is a market of opportunity that we will look back in 2 years' time, 3 years' time, 5 years' time, and we would say, good Lord, there was a dip in the market that if one were to buy a couple of properties in the right place at that time. But mind you, it's not for the weak-hearted, because you still got to go through some of the storm. And some of the storm means that while we sort of keep saying that it hasn't been legislated, as soon as it does become a legislation, then you will see that there is a second hit of that emotion dive. So our first hit of panic was that when they say we will legislate, we're still secretly hoping that it doesn't become legislation, which unfortunately it probably will. And as soon as it happens, then we'll sort of say, good Lord, it is a legislation. Then we'll have a second dip of the emotion, and then it will sort of settle in. So this period of time is genuinely is an opportunity, in my mind, only for the sophisticated investors who can go through the storm, who has got some, I suppose, the mitigation factor in their hand, which is enough level of the liquidity, and which they have the option. For the newer investors, whether you're sort of just sort of be a little bit more careful, but as long as you've got that longer term view, it will balance out.
Absolutely. And to add to what both of you said, without providing any financial advice, I would probably, as an investor, how I would look at it is, yes, what you said, Munzurul, is right. 2 years later, we'll look back and say, glad I bought it at that time. And everybody was panicking. As Warren Buffett says, you be greedy when others are fearful.
Yes.
And I never purchased properties for the negative gearing benefit, Munzurul, or the 50% CGT discounts. The basic strategy, what George said, is to build wealth, build generational wealth.
Yeah.
And that generational wealth has to be built over a longer term. There will be the short-term hiccups with the changes in policies, changes to budgets. And mind you, lenders are in the business of lending money. They will come up with ways to lend money within the careful lending measures. But there will be maybe longer loan terms. There may be longer interest-only terms. That sort of things would sort of balance out what has been lost to the negative gearing calculations to help the borrowing capacity.
I'll give you one very minor example, if I may, is that I've got a client of mine who sort of shared this example to me. Munzurul, it was my grandma at a point of time in 1950s, is that she had a small level of property. It was in front of the water, but it was nothing too fancy. The property was like an absolute shack, but it was in front of the water. And then there was some discussion from the council that because of the water and because of the seawater and because of some of the demolition, council may sort of change some of the rules and regulation in terms of what to do, and there could be some additional council rate, and there could be some renovation cost and so forth. My grandma looked into it at that stage. It was a bit of a larger land, 1 acre or so land in front of the water. That's fine. But because of some of those council sort of the adjustments, it was not as populated, nothing too fancy. My grandma says it's too hard, too difficult. She sold it. And I was like, okay. And I was like, you're going to tell me exactly what that land was. She was like, it was in Bondi Junction, right in front of the water, for 1 acre land.
Oh.
And I was like, okay. And she said, she's not very popular in our family. She is. We adore her. But financially, she was not very popular.
Wow.
I think it, again, teaches me a lesson that do not look into that, just that short-term hurdle.
Yes.
If you want to make that your longer-term wealth, your generational wealth, through your perpetuity over a period of time, you will go through ups and downs. Look into the bigger picture.
It's very sage advice.
Yeah, it is. And that was a classic example where short-term things should not be the reason for you to make a decision.
No, not at all. And again, it just goes to show really, no matter what events are, and I think that example was from the 1950s.
Yes.
So 75 years later, there are changes. And, we started off talking about pre-COVID, COVID, interest rate rises, falls, budget, the conflict overseas. And the thing is, there will always be something else. So even if this is legislated, if it's reversed, there will be other things where people will look at it and go, I'm going to wait for this. I'm going to wait for the election to occur or the next thing and the thing after that. Whereas to your remark earlier, Munzurul, I think the thing you can stay true to is your own compass, your own strategy. And yes, there are external elements. Understand how they impact you or not, but then try to execute your goals, adjust that where you need to. But if you just observe, time can pass you by. Suddenly you're priced out and it becomes a case of regret, unfortunately.
Those fence sitters always lose out, no matter what happens. Either the policy changes this direction or this direction. If you make a decision, you may end up making a wrong decision. However, time will correct it over time if you end up into a decision. As long as you get proper advice and seek all that you want to understand based on your strategy, I think rather than fence sitting, you understand whether it is time for me. As Munzurul said, 2 years later, we'll look back and say, wow, that was an opportunity. So trying to find the opportunity with the help of right professionals to understand how this fits into my generational wealth building strategy, really.
I agree.
Yeah.
Yeah, so Munzurul, before George goes to ask you a question about the house and land packages and units, I've got one question about the third implication of the budget, the trust.
Yes.
The trust investing and all, and changes in structures allowed and all. So how does that fit into this whole investment piece? How does that bucket company and all conversations coming up, how do they fit into this total puzzle as such?
Yeah, bit of a minefield. Yeah, bit of a minefield in the sense that what trust is to do as of now, the rule still the same, is that trust can, and when we speak about trust, we speak about discretionary trust. Yeah, so family trust, which you've got the discretion to distribute the way one wish to, based on the trust deed and based on the definition of the beneficiaries. So trust could distribute the profit in a very flexible manner. Means that there were quite a significant level of tax benefit in terms of trust investment as such. And also trust has got the asset protection because you control rather than sort of you own it as such, through being the appointorship. So those were two fundamental reasons why trust is to do. Trust didn't used to pay any tax. The beneficiaries used to pay tax on their own rate. And if there is no beneficiary, then trustee used to pay at a very high marginal rate, highest marginal rate. But generally, trust always distributes beneficiaries pays tax. And if the beneficiary is an individual, you get a 50% CGT discount. Means that even if you're at the highest rate, 47%, you only pay 23.5%. So there was a lot of benefit with the trust, which it still is. The new protocol, what it says is that from 1st of July 2028 now, rather than 27, is that they're saying some of those things will change. So trust will have a minimum 30% tax rate, yeah? Means that whoever the trust distributes is that trust will pay 30% tax in day one. Then if it's distributed to you as an individual beneficiary, you will look into what your marginal rate is. If your marginal rate is 47%, you pay the balancing 17. But if your marginal rate is 25% as an example, you don't get that 5% back. You actually don't get that 5% back. You lose away that 5%. Means there is a minimum 30% tax is being paid by the trust. So we didn't have that previously, right? So that has taken away just a little bit more as far as the edge of the benefit that we get. A second part of it is that it was very common for business owners is to say, common means it's a strategy being utilized often, is trust to have a dividends as an example, or trust to have some level of trust distribution as an example, going to a bucket company. We call it bucket company, investment company, property company, profit holding company, however way we name it. It's a corporate entity which is not trading. It's just purely sort of, I suppose, the holder of your wealth and or builder of your wealth. So it's an investment company rather than being a trading as such. So it was very common to distribute it to an investment company. Company's tax rate is 30% and you pay 30% tax. If it's coming in from a trading company, dividend back to the trust, back to the profit holding company. Trading company already paid 25%, so you pay only 5% difference. So you used to park all of those profit into the trading company at 30%. There are a number of benefits. There is from an asset protection, there is a benefit future investment. Common strategy that people used to do. What the rule now says is that if the trust distributes to a bucket company, that 30% tax that the trust has already paid, you don't get a credit for that 30%. Means that for $100 profit, trust has paid $30 tax, you've got $70 left. That $70 now goes back into the bucket company. Bucket company needs to pay another 30% tax on that $70, which will be $21. So you paid 30 in step one, and you paid 21 on a step two with the same $100. That means you paid $51 tax on $100 your overall profit, which is 51% tax rate, which is crazy insane. But that's where it is. Means that if this becomes legislation, which it probably will, if it becomes legislation, that strategy of bucket company profit distribution it's not beneficial anymore. Where there are some sophistication of the strategies, that it was very common that your trading company to be owned by the discretionary trust. Now the accountants started thinking very carefully, saying that, well, do we need to change that strategy? And do we need to have, rather than trust being owning the trading company, do we need to have an interposed entity between the trust to the trading company? There are some benefits attached to it. Where I sort of say couple of points, Sandeep, if I may, is that number one is that what ATO says is that if it does become a legislation, there would be some rollover provision, i.e. they would give us some time and opportunity to not correct or to restructure our existing strategy. Because it is the most common of trading company to be owned by a family trust. Very common. So that everyone does it. So the government knows it. And because everyone does it for years and years and years and years, you can't just completely change the rule because everyone gets as non-benefited as such. So there would be some time in terms of changing those structures. So that's probably the first comment that I'll sort of say. And the second comment that I'll sort of say is that within that rules and regulation, there are still ways that we can utilize the trust. Trust still has that your asset protection as a benefit. And while we say that there is a 30% minimum tax, it's not an extra tax. It's just that it's being aligned back to the profit holding company's tax, which was 30%. So they've taken away some of the benefits, but it is not all benefits being taken away. It's not as attractive. Still, there are some sense of attractiveness.
It's quite interesting. So I imagine as we approach some of those milestone dates, there'll be a lot of business owners, investors proactively reviewing their holding structures.
And absolutely, we must need to, right?
Yes.
This is with the assumption that, yes, this becomes a law.
Yes.
And that's why it's June 2028. So we still got 2 years,
time.
right? We still got 2 years. And my personal view is that, first of all, we make none of those changes until it becomes a law.
Yes.
Then my second personal view, even if it becomes a law, we wait it out for a bit.
Yes.
And we wait it out for a bit so we can understand all the different scenarios just a bit more. We can understand all of the law a little bit more. We can see it on the court a little bit more. And as long as we sort of change it before June 2028, it's fine. So the overwhelming comment which I say is that for all clients, sophisticated clients, you have to sit down with the accountant at some point of time. Maybe now it's a little bit too early. Let the dust settle a bit. But you got to sit down with the accountant saying, do I need to restructure? What are the ramifications behind it with the restructuring? Because there's many things. You don't just do a restructure, and there's potentially some stamp duty, but there's definitely some CGT impact to it. There are some audit risk attached to it, and there are some additional benefit that one can look into it.
And if I'm not mistaken, by June 2028, we would be potentially under a new government, right? We would have had the election by then. So it aligns with the election timelines.
Get ready for another set of changes. I don't know.
That could be one solution. So I guess in terms of going back to the negative gearing element, Munzurul, so the government, I guess, has designed it in a way where they want the home buyers to very much go into the house and land packages. And ultimately,
off the
plan units. And ultimately what it does is it obviously helps them lower price points, one would assume initially at least, but then it also stimulates construction, building and everything else. But from a price point perspective, I guess, what do you anticipate would happen to that, 24 months in? Are we seeing others other than the first home buyers come into play and inflating it, pricing them out?
Unfortunately, the history tells us that is what it happened in the past.
Mm-hmm.
That all it did is that the builders and sort of the suppliers of those properties and the products, so to speak, is that they sort of just increase the price a bit more simply because the demand of that sort of has increased.
Mm-hmm.
And that comes back to our earlier point, is that by doing it this way, who is the one who's getting benefited?
Mm-hmm.
You're giving a little bit more benefit on the first-time buyers, but they're purchasing in a property where there is a bit more demand, means that prices are a little bit higher.
Yes.
So that, unfortunately, could be a ramification. Has it happened in the past? Yes. Was there any exception to what had happened in the past? Unfortunately, there wasn't. Means that every single time when the government sort of did this or some of those legislation, the prices unfortunately adjusted. Yeah.
Yes.
And while the prices sort of adjusted, is that benefit wasn't being taken. And that's what I'm fearful again, George.
Would happen, absolutely. Because when you look at, I guess, the mortgage book of the country, structurally, it's in quite a good position, right? So
Yeah.
we're talking a portfolio worth several trillion, and with only sort of 15 to 17% of that mortgaged. So the ability to take on credit, despite the high interest rates, for sophisticated investors and migrants who are quite affluent coming in, they're able to do that.
Absolutely. Yeah, so question for both of you again. Certain markets have done really well in the last couple of years. To give you an example, Western Australia, South Australia, Queensland had double-digit growth every year. This was to become a legislation. How do you guys see things changing? Because suddenly, even if I want to buy in Western Australia now, for a price of about, say, 800, 850, I may not have the borrowing capacity to do that. Would that affect the markets as such in probably the next 2-3 years, given what growth they were expecting, and how it would probably change going forward? On how does the transaction ability to do the transaction in that space work?
So I personally believe in the short term, again, from a psychological standpoint, we're probably going to see a bit of a pause. And, Munzurul touched on it earlier, where we've had a dip and we'll probably have another dip. But I also believe the longer something goes on, people tend to move on with things and get on with what they need to do. And at the crux of it, we are talking about supply and demand. So if there's a slight pricing correction and it becomes an attractive point for these investors, even at the lower price points, to sort of go in, then ultimately it's that wave building up again. It's pressure building up at lower ends and those markets seeing growth again and becoming harder for home buyers to come in. I do also believe, just given the growth that we've seen on the West Coast, that a lot of the focus would move back onto the Eastern Seaboard, because again, Victoria, we've always said it time and time again, it's been quite attractive for quite a number of years. At the moment, there are really good opportunities in Greater Melbourne and even some of the regional hubs where investors are picking up properties in the 500K price points, right? And you don't really get that anywhere else. So I think the pressure will ultimately sort of push these things up. So personally, we expect a bit of a dip, but again, the demand is there. Nothing structurally has changed.
Yeah, I think my only comment which I'll say, I agree with all of this. Absolutely, I agree with all of this. The only comment which I'll say is that it probably will give a pause for an investor to re-look through and say, do those properties make sense in the longer period of time? So they would be challenged, not so much in terms of whether we have got a finance, whether we've got an opportunity. They will find a way to get the finance. And finance, there's always sort of a way that you sort of solve it, and bank will sort of give some incentive over a period of time. I sort of feel that finance will sort of sort it out over a period of time, even though there is a short-term challenge. But it will give a pause to the investors, is to say, okay, I can't buy that property quite immediately. Let's have a look through in the longer period of time. Does it actually make sense? Is it priced right, or is it being overinflated? And if it sort of seems to be overinflated, the investors will naturally try to go to somewhere else. So that almost that herd mentality that my neighbor has bought it and my friend has bought it, so I really need to buy this, you would have that layer of the hurdle. So I don't think it will change too much in the longer term, but you would have that moment to re-review.
Great, and be mindful of time, as we can listen to Munzurul for a couple of hours, 2-3 hours, when he talks these strategies and ideas and budgets and all. But mindful of time, one last question to both of you. I know we have discussed this in detail. However, if you have to put finger on a few things, that what issues does this budget not fix?
George, you go first, and then I'll go.
So from my perspective, I really don't believe it will achieve the outcome that it's set out to achieve. So ultimately, we're talking
Help
about
home buyers into their homes. More or less.
absolutely. I really don't think it's going to do that long term. Ultimately, again, the investors will reconcile their strategy. The market will reconcile itself. And the other element is there's a bit of an assumption being made by the government that first home buyers will want to live out in the regional areas where this supply would come in, where the affordable house and land package comes in. Because even if you're talking about Western Sydney, from a house and land package perspective, it's going to be upwards of $1.5 million.
Absolutely.
A new build, cost of construction is expensive. There are taxes, and all of these need to be recovered for a viable profit margin from a developer standpoint. So I think the government is making an assumption that these home buyers will want to live in regional markets. The challenge there becomes they might not want to. So ultimately, I don't really believe it will address the issues.
I think from my perspective, I agree. Everything George says, absolutely, I agree. I think it makes us a lot less internationally competitive. And that's what I suppose the fear factor is, yeah? So all sort of that trying to play around with the foreign investors and trying to really discourage the foreign investors, increasing this tax rate. Yeah, I mean, set aside that bucket company side of it, that CGT benefit being taken away, some of the other benefits being taken away, making us less and less competitive in terms of Australia already is a very highly taxed country. And after this, in some of the matters, we become the highest tax-paying country. CGT, as an example, is that when we are one of the highest, if not the highest, in the OECD countries. And that will have an impact. And the challenge is that impact will have a flow-on impact with everything else. And that whole recession that we're sort of hearing, all that is stagflation, we're sort of hearing all of those. I don't know whether it's helping any of those, yeah? Rather than really giving a boost on the economy, we're still looking into that sort of a small section of it that we're trying to fix it. In my view, is sort of almost in the wrong way. So I don't know whether I'm a big fan of all those changes in the budget.
Yeah, great views, guys. And I sort of agree with you too. Like it's as you said earlier, it's a band-aid approach to the bigger problem. Like it's not going to solve the supply issue by dampening the demand in the short term or pushing the demand towards the newly builds. And we are not building houses fast enough than what we require. And it's just going to have a large number of people chasing small stocks, and it's going to increase the price of the newly builds, which again in the long term, whether it is a great exit strategy as such.
Yeah.
Right. So if I'm an investor, property investor myself, or investing in for all those things like crypto, stocks and all, my view again would be long term. Things will adjust themselves out in the long term. And as long as my strategy is to generate wealth rather than save taxes or bank on some tax savings the government throws at me, it's more about building wealth in the long term, and things will work it out itself out. Like property investing, for example, is 10, 15, 20, 25-year game.
Yeah.
And the growth you get over time, I don't see a reason why I should be stopped. I should be pausing my investment journey as such. But one tip I got from today's podcast is 2 years later, Munzurul is going to say that this was the time to buy. So won't be surprised if I come to you guys saying I want to buy another property.
We still need to be, I suppose, prudent. We still need to make sure, my view, that we need to be prudent. That means we just need to sort of buy that right property. We still need to ensure that we've got a mitigation factor, right? Mitigation factor means that we've got enough level of sort of, I suppose, cash flow and liquidity in our hand, so that sort of the storm, so to speak, if it goes a bit longer, that we can manage it. We still need to have our risk assessment as such that now we're sort of saying, are we getting now on the top of the interest rate? We don't know. It's such a butterfly effect, right? What happens if the interest rate even goes up a little bit more? What happens if it stays there much longer period of time? Whatever reason, the rent sort of doesn't go up as high as we can. So we got to tick away all of those boxes of the risk, right? So it's not just a buy. It's just as long as all those risks are being very well considered, I think the opportunities are a lot more now than what we have seen probably about 2 or 3 months earlier, and what we probably will see in about 2 years' time.
Great. Thanks, George, and thanks, Munzurul, for joining us on this episode and trying to unpack the budget and what it means for investing as such going forward. So, I myself got a few doubts cleared. There was so much noise, so much in the social media and whatnot, and it's not as bad, is what we think. And we look forward to seeing more details of it as things passes then becomes a legislation and whatnot, and the journey continues with a little bit of pause and a little bit of more due diligence, I believe, gents.
Absolutely. Munzurul, would love to have you back in about 6 months or so once it has legislated in some shape or form.
I'd love to.
Just to do a bit of a look back and see, where we landed.
I'd absolutely I'd love to. Thank you.
Yeah, George, and let's thank Munzurul for being kind. He's been traveling internationally and then comes back and
so much.
on a short notice joins us on this podcast. Munzurul, I myself personally learn a lot from you.
Likewise.
A lot from you, and George is the same.
Likewise. Always a pleasure.
No.
So when we thought we want to talk about the budget, George was saying, can we check if Munzurul is available and can he shed some light on what it is? So thank you very much. We are really blessed to have you alongside us and trying to help our audience understand what it means.
Thank you very much. And thank you from my point of view as well, because as Sandeep, we're mates. We're friends for years and years. George and I, we're mates for years and years. So absolute joy, absolute privilege. Thank you. Thank you for having me.
Thanks, everyone. Thanks for tuning into this episode. We'll come back in the next one with something more to unpack. Thank you and see you next time.